Hello. In this chapter, we're going to be talking about dividend policy, and we're going to talk about what determines whether or not a firm pays a dividend or how large the dividend would be. The difference between a dividend payout ratio and the actual dividend payout, or the dividend per share. Also, we'll take a very light look at some dividend theory and conclude with how are dividends actually paid out and what are stock splits and stock dividends and stock repurchases and how does all that come into play. So first of all, these are determinants of dividend policy. These are the things that the management of a company has to think about before they can implement any sort of dividend policy. So one thing they want to consider are the industry and company variations in the dividend payout ratios. For example, just because your main competitor is paying out half their earnings in dividends doesn't mean that you're going to be paying out half your earnings in dividends. However, on the other hand, if their dividend payout in terms of dollar dividend makes that stock attractive to a competitor, then perhaps it's something you need to consider doing. But there's more to it than that. You have to look at the number of profitable investments that you can invest in. So perhaps you're better off using your money to reinvest back into the company, and then you can give your shareholders returns in the form of capital gains rather than just dividends. So you kind of want to see what the industry is doing, but also understand that, and I'll show you a graph later on, that within an industry there's huge variations in terms of what the dividend payout is actually going to be. A big consideration are going to be your legal constraints. For example, the bond indenture is a good example of that. A bond indenture will limit the amount of dividends that can be paid, so you have to just be sure that you abide by any constraints that might be there to protect the bondholders. An example of this would be, a bond indenture will limit your dividends so that management would never be tempted to liquidate a company that might be in financial distress and then pay all that money out in the form of dividends to its shareholders, leaving nothing for the bondholders to claim in the event the firm goes bankrupt. So to prevent that from happening, the bond indenture will limit the amount of dividends that can be paid, and that's a legal restriction and also a restrictive covenant that would be contained in the bond indenture. So any other restrictive covenants that could be contained in the bond indenture, you'd have to watch that as well. Tax considerations. There we're talking about the tax considerations of your shareholders. Generally, your higher income tax bracket shareholders prefer capital gain returns rather than dividend returns. And just as a quick review, you know that shareholders get their returns two different ways. They can either receive their return in the form of capital gains or in the form of dividends, and or a combination of the two. Actually, they can get it three different ways. And so if you get your returns in the form of dividends, you have to pay taxes on those dividends that year. So that's why it's your lower income tax bracket investors that generally want to supplement their current income. They're the ones that prefer dividends. So perhaps retirees would be a good example of that. On the other hand, your higher income tax bracket investors that don't want to receive the dividends because they don't want to pay taxes on it right now, they prefer to receive their returns in the form of capital gains, and you don't have to pay taxes on those capital gains until you actually sell the stock and what we call realize those capital gains, actually cash in on those capital gains. So your higher income tax bracket investors prefer that. Liquidity and cash flow considerations. I mean, obviously the firm has to have the liquidity on hand to be able to meet the dividend payout. It is perfectly acceptable to take a short-term line of credit if that's what it takes, because maybe you have a lot of money tied up in inventory or receivables, and so you just don't have enough cash on hand right now to make your dividend payment. Then sure, you can take out a short-term line of credit. But generally what you don't want, you shouldn't be doing, is taking out long-term debt and then turning around and paying that out in the form of dividends. And then the borrowing capacity and access to capital markets, that makes a difference as well, because if yours is a growing firm, then that means it's going to need a lot of money to fund its growth projects. And so if they don't have a lot of access, if it's not a well-known company that has access to the capital markets and is limited in terms of what it's going to be able to borrow, then they're probably not going to want to pay a dividend at all. They'll probably want to take those earnings and reinvest it back into the company and then offer their shareholders returns in the form of capital gains. On the other hand, just to take the opposite example, if you've got a well-known firm that has tons of borrowing capacity and lots of access to capital markets, everybody knows Apple, everybody knows Caterpillar, everybody knows Ford, everyone knows Microsoft. All these companies have wide access to the capital markets and can get all the funding that they need. So, they don't have to restrict their dividend policy unless they want to in order to fund growth. Earning stability is another thing that's important. If you have a lot of instability in your earnings, then it might make it difficult to make the dividend payouts on some quarters, and that is something you absolutely don't want to miss. You don't want to miss a dividend payout. Managers of firms will only cut a dividend if it is a last resort effort. It's a last resort move. In other words, the market perceives, and this is where signaling theory comes into effect, the market perceives it as extremely bad news if management decides to cut the dividend. That sends a signal to the market that management apparently does not expect the firm to rebound anytime in the foreseeable future. Otherwise, management would not cut that dividend. And so if you have volatile earnings, you just don't want to put yourself in a position where you might have to cut the dividend in order to be able to pay it, because that will send a terrible signal to the market. Investors do not like that. They like dividend stability or growth, and the stock price would get hammered when you cut that dividend. So you want to make sure that when you set a dividend, it's something that you can maintain permanently. And then I've kind of implied this already, but the growth prospects of the firm is very important to consider when you develop a dividend policy. If it's a high growth firm, then it's likely that you're not going to pay any dividend, or you'll pay a very low dividend, because you'll need your money to reinvest back into the company to fund those high growth projects. And you would rather use retained earnings and fund those growth than issue additional shares of stock. Because first of all, it's more expensive to issue additional shares of stock. You have to pay flotation costs. You have to pay your investment bankers when you issue additional shares. And there's other disadvantages as well, as we talked about in the stock chapter. But dilution of earnings. You get so many shares out there. You run the risk of another party trying to buy up those shares and perhaps take over the company. So if you're a high growth company, chances are you're going to pay little or no dividend because you need those earnings to fund your growth opportunities. The other thing you want to consider is shareholder preferences, which is also referred to as the clientele effect. Modigliani and Miller referred to this as the clientele effect, and that is, if your company traditionally has been paying dividends, then it's probably not a good idea, unless you have to change your dividend policy, because you've basically developed a clientele of individual investors that want those dividends. Otherwise, they wouldn't haven't necessarily invested in your firm. If they didn't want dividends, then they would have invested in a high growth firm that gave their returns in the form of capital gains. So you have to kind of consider the fact that if you've been paying good dividends all along, and then you want to change that policy, your shareholders are probably not going to like that, because they've invested in you because you have been paying those dividends. Or it might be the opposite case. They invested in you because you don't pay dividends and you use your money to fund growth, and therefore I like that because I don't have to pay dividend or have to pay taxes on any dividends, and as long as I don't cash in the stock, I don't pay taxes on my capital gains. So you're going to attract the type of people that are attracted to your dividend policy. And then finally, I mentioned this earlier too, you want to protect against dilution. So again, if you pay a large portion of your earnings out in the form of dividends, and then you decide you need money in order to fund your growth opportunities, then you're going to have to issue bonds and stocks, and anytime you issue additional shares of stock, you run the risk of diluting your earnings, and so your earnings per share can go down, and investors keep an eye on that earnings per share figure. This is a table that's in your book that's just kind of interesting. It shows the dividend payout ratios for different industries. Now, first of all, let me emphasize that a dividend payout ratio just tells you the percentage of income that's being paid out in the form of dividends. It's not the amount of dividends that are being paid out. Okay, so it's not saying that we're paying out $3 in dividends every quarter or every year. We are paying out 20% of our earnings in the form of dividends on average. It's kind of an average amount. So notice how much variation there is. There's a huge amount of variation here. You've got the biotech industry, which basically pays 1% of their earnings on average in dividends. In other words, probably most of the firms do not pay anything in dividends, and then you might just have a few firms that pay some out in the form of dividends. And that's because these biotech firms are generally very volatile, very risky, so they don't have a lot of earning stability, and those that are successful are very high growth, so they're investing the money back into the firm rather than paying it out in the form of dividends. And then if we go to the other extreme, where you've got your utility companies, which do not have, tend to have very little in the way of earnings variability, because it doesn't matter if we're in a recession or whether we're in a booming economy, you still need gas and electricity. And so either way, they're going to make earnings, and so they tend to be able to in terms of growth, they might have some growth as certain areas of the country grow, but usually the growth for most of them are limited in areas, and so they tend to have a much higher dividend payout ratio. They pay out, in other words, most of their earnings, more of their earnings, definitely in the form of dividends. Now this slide is interesting because this is taking one industry. Okay, so before we were looking at a bunch of industries. Now we're taking one industry and looking at the variation of the dividend payout ratio just within that one industry. So here you can see in the aerospace industry, you've got here a bunch of companies that don't pay any dividends. Okay, so chances are it's either because of earnings instability or because of high growth, or a combination of the two. And then, again, I like to go down to the other extreme. You've got Lockheed Martin and Honeywell, which have been around forever. Very, very steady companies. Earnings are much more stable for these companies. Very well-managed, well-known companies. Have a lot of business. Probably have less in terms of growth opportunities than maybe some of these other types of defense, aerospace defense firms. And so they pay a much higher proportion of their earnings out in the form of dividends. So even within an industry, there's a huge standard deviation in terms of the dividend payout ratio. The next question is then, do dividends matter? That's the next thing we want to look at. So now we're going to get a little bit into just what we call light dividend theory. And we do have some disagreement as to whether or not dividends matter. If you remember Modigliani and Miller from capital structure theory, they make a return talking about dividend policy and firm value. And basically, Modigliani and Miller argue that dividends are irrelevant to the value of the firm. And again, their conclusions are based on a lot of assumptions. Okay, and here, this is just some of them listed here. And to just try to explain it in a nutshell, basically what they do is they argue that there is no value in a firm doing something for an individual that the individual can do for themselves. Okay, so stated another way, they would argue that there is only value when a corporation is doing something for the individual that the individual can't really do for themselves. So therefore, what corporations need to be doing is continuously looking for growth opportunities and just investing in one growth opportunity after another. That's the obligation of the management of the firm. They would argue against dividends because they say, why pay a dividend? If investors need money, let them cash in a stock then. They can cash in all their stock or a share of stock or however much they need to meet the amount of money that they want to get. But so in essence, they argue that they can pay themselves a dividend simply by selling a share of stock. But what they can't do is go out and seek out all the different growth opportunities that this firm possibly has access to. And so they argue that that's where the value is. The value is in not paying dividends, but rather seeking out those growth opportunities. Now, having said that, though, they do concede that there is signaling information. These two kind of go together, that there is informational content associated with dividends, and that does signal information to the market. In fact, dividend policy is a strong signal to the market. So to give you an example, if you see a company giving the same dividend quarter after quarter after quarter after quarter and they never miss a dividend, you would say that that's probably a very stable company, not growing a lot, otherwise they would increase their dividend, but a very stable company, that seems to be doing quite well. On the other hand, if you saw a dividend that was being paid every quarter, but it was increasing a little bit. So let's say it increases just a little bit every quarter, increasing. That sends a slightly different signal to the market. There's information contained in that dividend policy, and that is that this is a company that is not only stable, but it seems to be growing each quarter, and apparently feels optimistic about the future, because they would not be increasing that dividend every quarter if they didn't feel they could maintain that dividend increase permanently. So that sends a very strong positive signal to the market. On the other hand, as I mentioned before, if a company cuts a dividend, that immediately sends a terrible negative signal to the market that this firm is having problems, and apparently they're so bad that management doesn't see a solution to this in the near future, and so they have no choice but to cut the dividend. So that's the information that's kind of contained within that dividend policy, and it is signaled to the market. The market looks to dividend policy as a source of information. And then I've already mentioned Modigliani and Miller talked about the clientele effect, and that again is that investors invest in the type of stocks that pay or don't pay the dividend that they expect them to. In other words, if I don't want a dividend, then I'm not going to pay in a dividend. I'm not going to invest in a dividend-paying stock. On the other side, in strong disagreement, you have Gordon and Lintner that argue for the relevance of dividends. And before, where we had the constant growth model, this model was actually not developed to price securities, but instead was really developed as a dividend theory model. And what Gordon and Lintner argue is that when you remove the restrictive assumptions under Modigliani and Miller, basically they create this model that shows that if you increase, so let's say you increase next year's dividend, what Gordon and Lintner would argue is if the dividend for next year is going to be increased, then investors are going to feel more positive about the company. In other words, it's a positive signal to the market, right? Like we said before. And if that makes investors feel more certain about the firm's future, then therefore investors react by decreasing perhaps their required rate of return on the stock. And so if you increase the numerator and decrease this denominator, what's going to happen to your stock price? It's going to go up. And so where Modigliani and Miller argued that really dividends themselves are not relevant to the firm, they did concede, like I said, that there was an information effect, clientele effect, and a signaling effect. Gordon and Lintner argue, in fact, it does impact the value of the firm, that if you increase a dividend, it will cause a share price increase. And we do have a number of studies a lot of studies that support both of those arguments. And so we have what's called, and there's other dividend policies I should add as well that we don't get into in here, but those are the two prominent ones. And so we have what we call the dividend puzzle, because we don't really have any major clarification on that answers all our questions regarding dividend policy and firm value. So how do we conclude then the relevance of dividend policy, because obviously companies spend a lot of time trying to figure out what's the best dividend policy for them to offer. And basically most of your practitioners believe that they have a strong informational content, and there's a whole lot of empirical support behind that. And so because of that, they will not cut a dividend, and they're just very careful when they make any changes in the dividend policy to not do anything to send a negative signal. So they do believe strongly in informational content. And then also, as I mentioned earlier, they're careful about not paying all their earnings out in dividends if they're a growth company, because otherwise then they have to issue external equity or common stock, which is more expensive. Now there's several types of dividend policies, and I'll talk about these briefly. The first one, and these are dividend policies that firms can choose to use. The first one is a passive residual policy, and this would be one that Modigliani and Miller would propose. And the passive residual policy says that a firm should first seek out any and all growth opportunities, and then if there happens to be any money left over at all, then you can pay that out in the form of dividends. But don't worry about paying dividends. Your primary concern should be seeking out those high growth opportunities. Now the problem with the passive residual policy, nobody follows that, because it would mean that your dividends would fluctuate from quarter to quarter, and we know that the information content associated with that fluctuation would be awful, so companies don't do it. And then the other implication is that growth firms wouldn't pay out dividends, or would have a very low dividend payout, which we actually see to be true most of the time. Particularly your high growth firms do tend to have low dividend payout ratios, because they do use most of their money to fund their growth opportunities. But this reason right here, the fluctuation of dividends, is why we do not see companies using the passive residual policy. What we do see companies using would be the stable dividend, dollar dividend policy, which would be paying the same dividend quarter after quarter after quarter, and not missing a quarter, and signaling to the market that you're a very stable firm. Under the stable dividend policy, you do not want to reduce dividends. The only way in which you would reduce dividends is if you had no other choice, so it would send a very strong negative signal. Increases in dividends will only occur if you're sure that you can maintain that increase for the foreseeable future. In other words, you expect that increase to be permanent. So increase in dividends tend to lag increases in earnings. In other words, the company wants to see that their earnings are going to stay high before they say, okay, let's go ahead and increase the dividend. One good quarter isn't going to cause them to generally increase the dividend. And then, as we mentioned before, investors like stability. They like to see stability, and if they see stable dividends, that signals stability to investors. So this is another graph that shows, and again, this is showing the dividend payout ratio, so the percentage of net income that they're paying out in the form of dividends. And you can see here, if you look over time, and this goes from 1960 to the year 2010, you can see how dividend payout ratios will fluctuate. In other words, in order to maintain a constant payout, so in order to maintain that constant $2 dividend, $2 dividend every single quarter, if I have to pay out 90% of my earnings in order to meet that $2 payout, then that's what I'll pay. But if things are going well and I only have to pay out 50% of my earnings to meet that $2 dividend payout, then that's good for us. It leaves more money than that we can use to reinvest back into the corporation. But point being, the dividend payout ratio will fluctuate. The percentage that it takes for them to meet that fixed stable dollar dividend will change, because their first priority is to make sure that they meet that dollar dividend, whatever they've promised. So I think that's the major takeaway from that. This graph, I like this one too. This one's in your from your book. Notice how this is for Leggett's, so this is a department store. Notice how they have an increasing dividends per share. So these are the actual dollar dividends that they're paying. So notice how, earnings aren't nearly as smooth as dividends, but notice how earnings are going up, and so they're not increasing their dividends nearly at the same rate that earnings are increasing, but they're showing confidence in what they feel the future of their earnings are going to be by slowly increasing their dividends. We see that. And then, even when there's a downward trend here, notice how they still have confidence in the future and they still continue to increase that dividend. And so we see a little bit more volatility, but sure enough, here Leggett's comes back again and does well, and then bombs in 2007. So in 2007, they totally bomb, but look what Leggett's does. Instead of cutting the dividend, if they would have had this earnings per share and then said, okay, we had a terrible year, we're going to cut the dividend, that would have sent a signal to the market that Leggett's did not expect to ever rebound from this big dive in earnings. And they wanted to send quite the opposite signal. If you'll look, they actually increased the dividend even though earnings per share took a nosedive. And they did it even more here to try to signal to the market that we know we're coming back. We know we're going to be doing well. We just had a bad year. This is the Great Recession that's going on here. So we have a bad couple of years, but look, we're coming back, and sure enough, they were right. This is some good management here. So they were right, and they're right back on their way to their high point again. And notice how they kept the confidence up by not ever decreasing the dividend, and in fact doing quite the opposite, increasing the dividend. It's an interesting graph. Okay, and here again, this is for General Motors. This is showing you the volatility in the earnings per share for General Motors, and you kind of see it's all over the place. And unfortunately, not everyone is like Leggett's. I mean, here we have an increase in dividends, then they go through a period where they keep it constant, and then they get brave enough to increase it a little bit and then make it constant again. But then when they have this huge loss that begins in '89 and hits the bottom in 1991, apparently General Motors is feeling enough pain and not quite so optimistic about the future that they actually cut a dividend. And when they cut these dividends, if you were to go back and look at the stock prices of General Motors during that time period, you would find that their stock price got hammered. Between the low earnings per share and then on top of that cutting a dividend, their stock price had to be at an all-time low. And then we see that they start rebounding after 1991, and notice that there's a lag, but you do finally see a little bit of an increase in dividends, and then it stays pretty constant, and then they cut it again when they have another deep dive in 2005. So not everybody's graph looks like Leggett's. Like I said, Leggett's was a very well managed, General Motors a little less so, but interesting to to look at the difference. So now we get into the nuts and bolts, how dividends are paid. So you've got the declaration date, the record date, or what's oftentimes called the record of holder date, the ex-dividend date, and the payment date. And so let's go ahead and talk about each one of these. What will happen is the board of directors will meet and declare a dividend, and that's your declaration date. And they will declare the dividend to be paid to the holder of record on a specific date, with the payment date, which is the date where they actually cut the check, and they'll specify that date. So where does this ex-dividend date come from? That's kind of an artificial date that had to be created. So let me show you what these dates look like on a timeline, and then it'll make more sense and I can explain those dates. Okay, so the board gets together on Tuesday, January 15th, and declares a dividend of, let's say, 50 cents a share. Okay, to be payable to holders of record on January 31st, 2000 whatever, with payment taking place on March 1st of that year. Okay, back in the day, back in the late 1890s, or late 1800s, early 1900s, and so there were so few stock transactions that occurred that whenever a trade was made on this record date, those transactions could be booked that same day. Well, today, with the millions and millions of transactions that will occur on any given day, we need 2 business days to record those transactions. And actually used to be more than that. The ex-dividend date is now only 2 business days before the record date. It used to be more than that. So now we've got really this artificial date called the ex-dividend date, and this is really the date that determines who receives the dividend. Okay, and this is very important. Whereas traditionally, whoever happened to be holding the stock on this day was the person that received the dividend. So if you sold the stock on this day and someone else bought it from you on January 31st, then whoever bought the stock from you on January 31st would be the person that would actually receive the dividend. That is no longer the case. Okay, it doesn't work that way now. Now, in order to receive the dividend, you have to own it January 28th. Okay, in other words, you have to own it before the ex-dividend date. All right. So sometimes it's a little bit confusing for students. So think of it this way. I always tell them, X means without, right? Ex-boyfriend, ex-girlfriend, they're out of the picture. They're gone. So if you own the stock, if you buy the stock January 29th, you're buying it without the dividend. Dividend's gone. Ex-boyfriend, ex-girlfriend, gone. So if you want to buy it so that you receive the dividend, then you need to buy it by January 28th. Okay, so whoever actually owns the stock on January 28th will be the individual that on March 1st will receive the dividend payment. Does that make sense? Dividend reinvestment plans. These are oftentimes referred to as DRIPs. This is where when a company pays a cash dividend, you can oftentimes they'll allow you to enroll in a dividend reinvestment plan where you will actually never really receive the dividend. Instead, they'll use that dividend to buy you additional shares of stock in their company. And so it allows you to continue to just keep reinvesting in the company. automatically. And sometimes they will issue existing, sometimes when the stock that they give you when you do a DRIP plan like this will be stock that's already been issued and maybe set aside in the Treasury stock account, and they pull it out. Other times it might be brand new stock that they're issuing to supply the DRIP investments. From an investor standpoint, it's nice because there's no brokerage commissions. The firm just automatically takes care of it for you, and so you don't have to pay any fees. But from a tax standpoint, it's not so nice because the IRS views this as you receiving the dividend and then taking the money and buying additional shares of stock. So you get taxed on that dividend even though you really never held it in your hands. Okay, you told the company to take your cash dividend and buy additional shares of stock. So the IRS sees that as a cash receipt, and you are taxed on those dividends. And so that's the only downside really to a DRIP. What about stock dividends and stock splits? Do they create shareholder wealth? We hear about those. We actually talked about dividends and splits earlier in quite a bit of detail, but I'll review it some here. We know that it does not create additional wealth. Okay, so for example, here we've got a pre-stock dividend, so stock dividend hasn't been issued yet. So here, notice we've got common stock with a $5 par value, and there's 100,000 shares outstanding. So the common stock account has $500,000 in it. It's the par value times the shares. Then the paid-in capital account, this is the account that captures the money that the stock sold for beyond par value. So, in this case it looks like, assuming this was, a one-time sale, it sold for $10 above par value, so it must have sold at $15 a share if we make that assumption. Then the other $10 a share is captured here in the paid-in capital account, or what they're calling contributed capital in excess of par, same thing. And so that's your $1 million. And then the company has retained earnings of $5 million. So the total common stockholders' equity is $6.5 million. Okay, if they decided to issue a stock dividend, and let's say that the stock dividend, it looks like what they're doing is they're saying for every 10 shares that you own, we're going to give you an extra share. So what happens is now you've got 110,000 shares, or the company has 110,000 shares outstanding at $5 par. So the common stock account, it did increase, okay, because you've got more shares outstanding and they've got the same par value. So that did increase. And then also the paid-in capital account, that increases as well to reflect the extra 10,000 shares. So we see the increase there reflected for the extra 10,000 shares. But the money that increased in those accounts came out of retained earnings, because keep in mind it was a stock dividend. They didn't, there was no, the company didn't receive any money from that. They just issued a stock dividend, perhaps in place of a cash dividend. And it could be that they were wanting to conserve cash for a quarter or two. Sometimes if a company wants to take over, they're planning a takeover or some major project, they might stop cash dividends for a quarter or 2 quarters to conserve cash to pull off this project. Empirical studies tend to show that if they can sell that to the market can be okay with that as long as cash dividends resume within 6 months after after the period where they stop. But to try to maintain a positive signal and keep things as positive as possible, sometimes what they'll do is issue a common stock dividend instead. And the common stock dividend doesn't add any value to the issuing firm, because like I said, it really just comes out of retained earnings, and it doesn't add any value for the investor either, because what would happen is you would be holding more shares, but the price per share would drop proportionately so that your total holdings are the same. Now down the road, if that nice big project that they invested in ends up bringing in a lot of extra money, it could mean an increase in dividends for you down the road, and you've got more shares now to get dividends with, so that could pay off down the road. The other thing firms can do, and this is our final thing, is share repurchases. And there's a number of different reasons why firms might repurchase their shares. It might be that they have so many shares out there that they've saturated the market, and so they need to pull, the stock prices may be a little artificially low because there's too much supply, so they might pull back and buy back some of those shares. They may also be buying back shares so that they can reissue them later for DRIPs, dividend reinvestment plans, or for executive stock option plans, or employee stock ownership plans, convertible securities. So when they buy these shares back, it becomes treasury stock. It goes into the treasury stock account, and they can buy it back by going into the open market, just like you and I, and buying the stock. They can do a private purchase, so it might be that perhaps they have a private placement with one big institution, where they've sold, 1 million shares or 200,000 shares to this particular institution, and so they just buy that chunk of securities back from them. And then the other option is to make a tender offer, and that is just make an offer out in the marketplace. And let's say the stock's worth $25 a share, and then you want to buy back, your firm wants to buy back a bunch of shares, so they might offer $26.50 a share, so an extra premium to get more shareholders to give up their stocks, and allow the firm to buy them back. And another reason you might see a stock repurchase is because there could be a capital structure change, and it one of the benefits is it does increase the earnings per share of the remaining stocks that are left, because now the earnings are spread over a smaller base of stocks than it was before. So when a company does decide to repurchase shares, they do usually announce that, and oftentimes that's viewed as positive news, because it also means that they've got enough cash on hand to implement the share repurchase. And when they repurchase these shares, of course, since the number of shares outstanding are declining, the stock price is going up, so your investors are getting returns in the form of capital gains. So that is dividend policy in a nutshell.